environment. Investing does not have to be complicated. In fact, there are just 4 things you need to understand to invest with confidence. Those 4 things include the stocks, bonds, and cash building blocks that I talked about previously, diversification, asset allocation, and rebalancing. So let's dig into each one with a little more detail. There are 3 basic asset classes. We have stocks, bonds, and money market instruments. Each asset class offers different levels of risk and return possibilities. Even within one asset class, you'll find choices with higher risk and higher return potential. Some stocks are more risky than other stocks. That's one way to look at it. With bonds, which have generally moderate return prospects, but carry less risks than stocks, an investor loans money to a company or government, which then pays the investor principal and interest on that loan. Stocks, however, represent a share of ownership in a corporation or a company or partnership. Money market instruments have the lowest risk, but also the lowest return potential. Money market instruments generally strive to maintain a $1 net asset value, although there's no guarantee that the instrument will maintain such value due to inflation or other factors. These statistics are meant to familiarize you with how investments have performed in the past. No one can predict what will happen in the future, however. You may have heard before the old saying that says past returns are never indicative of future results, so that's definitely something to consider. Let's talk stocks. For the 20-year period ended December 31st of 2019, the S&P outperformed every other type of investment, returning an annualized average of 7.68%. Oh, just a sec, we're skipping over to asset allocation. S&P 500 investments carry higher risks. In the short term, prices may be volatile. You may even lose money, but their historic performance indicates that stocks provide the greatest potential for long-term growth. Although there is no guarantee for the future, it's just something to keep in mind looking at historical performance. Now let's look at bonds. Bonds have produced an annualized return of 5.08% over the same 20-year period, but with a lower risk of price fluctuations. Bond prices also fluctuate, but keep in mind that as an asset class, bonds offer a wide range of risk and return. There's some bonds that yield more, but also carry much greater risks. One risk to the bond portfolios one consistent risk is interest rate risk. If Federal Reserve or another agency raises interest rates, we may see bond prices decrease. We can talk a little, if you want to talk further about that, feel free to contact me afterwards. The relation of bonds and interest rates is an important consideration. Money markets represented by 90-day treasury bills generally offer the lowest rate of return, but also involve the lowest risk of fluctuations in value. They may be best for short-term goals or for emergency savings, but as a long-term investment, they may not necessarily be the best choice. On this slide, we present 7 sample asset allocation models that you may find useful when setting your own target allocation. Each pie represents a certain level of risk tolerance, from low risk or ultra conservative for those who are comfortable with principal losses, to higher risk or ultra aggressive for those that are uncomfortable with principal losses would be ultra conservative, ranging to those who are ultra aggressive or those that are willing to take above average risk for potentially higher returns. Under each chart is a list of 5 asset classes and the suggested percentages of cash to allocate to those asset classes to meet the target allocation goal. Remember, the asset allocation does not prevent losses or guarantee a profit. It is a way to potentially reduce your risk of experiencing severe losses by being too heavily concentrated in a single asset class. Say small cap stocks. If you're invested entirely in small cap stocks, you may see much more volatility than if you're invested in a combination of stocks, bonds, and money markets. Rebalancing. Rebalancing keeps your plan from getting out of whack by having too much in bonds or stocks. Rebalancing is adjusting your mix of stocks, bonds, and cash to an original target. If one of your asset classes has done well in the past year, you may want to sell some to bring your portfolio back into balance. Here's an example. You may want to own 60% of your portfolio in stocks and 40% in bonds, but due to a stock market rally, you now own 70% in stocks and 30% in bonds. You can rebalance by selling your stock holdings and buying more bonds to get back to your original allocation. And then many financial experts believe that rebalancing once a year is sufficient for typical investors. Rebalancing does not necessarily guarantee a profit or protect against losses. It's just merely making sure that your goals are in line with what your allocations are currently.